Paul Meeks heads up technology research at Freedom Capital Markets. Paul, great to see you today.
You too.
All right, so can we just get through the big angst-inducing headaches that AI is having right now? One, and you heard Jim Cramer talk about it this week and what the Wall Street Journal calls Frankenstein financing. What's the deal with the debt? Is it a problem?
I don't think the debt in this case is a problem like it was with the companies that were borrowing in the late 90s, early 2000s when they're building the internet infrastructure. Because back then, there were a lot of really crappy companies with weak balance sheets borrowing. And the fact is they were borrowing. In this case, we do have a lot of interwoven relationships on an equity basis, not necessarily a debt basis, with companies building out AI infrastructure. So first of all, more equity than debt. So you don't have to worry about not making interest expense payments. And the other thing that's distinct this time is that 90%, at least thus far, of the AI infrastructure is being built by the 5 hyperscalers who all have very big balance sheets, very strong cash flows. And if they wanted to borrow, they could. Most of them haven't yet. And it would be very easy for them to do that. Now, over time, we have to see some ROI from all these investments, no doubt. But I don't think we need to get there for a couple of years yet.
There's a lot of drama following Michael Burry's post about underestimating the depreciation of all of this expensive infrastructure. If this were Shakespeare, would it be The Tempest or would it be Much Ado About Nothing?
Maybe somewhere in between. You know, they obviously, when you lengthen the life of your asset, you are going to, at least in the early years, lower your depreciation expense, which is going to boost your earnings. But the interesting thing is, I don't want to be an analyst because I've been around for decades and say I don't care about earnings, I don't care about cash flow. But in these cases, I think I want to see my company spend heavily in 25, 26, 27. So I'm looking at revenue growth, not necessarily over that period as they build the infrastructure in earnings growth. So I don't want to say it's not germane over the long term. Sure it is. But in the short term, I'm not worried about that metric.
How long do you think the AI infrastructure trade is still an opportunity?
I think at least for another year. What I see happening is, and we know this from the vows from all of the CEOs of the people that are spending the money, that they are going to spend even more in 26 off a very high 25 base. And so I think that's locked in. The interesting thing is what happens in 27. I think that growth will slow and maybe overall expenditures even plateau, but I don't expect them to collapse. And so I think this trade goes for at least another 12 months.
I'm looking at a couple names on your highlight list. You've got NVIDIA, which doesn't get any attention from us ever, and and CoreWeave and Nebius Group, which has AI technology assets. Why do you like them? That's right.
I'm interested particularly in the neo clouds, such as CoreWeave and Nebius, and even Applied Digital. And of course, next week on the 19th, we have NVIDIA, so they'll have a lot to say because everybody is interwoven with them. But CoreWeave took a huge faceplant last week when it reported its results, and they reported a guidance revenue miss of only 3%, and their stock went down 20%. I am not necessarily worried that this company is going to be in any sort of a fundamental free fall. I actually think the things that they can control, they do very well at that company. And I think it's a hell of a buying opportunity here at 7.
What are you worried